Ladies and gentlemen, good day and welcome to the Q4 FY26 results conference call of Mass Financial Services Limited, hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on a touchtone phone. Please note that this conference is being recorded. I now hand over the conference to Mr. Renish Bhuva from ICICI Securities. Thank you and over to you, sir.
Thank you. Hi, good afternoon everyone and welcome to Mass Financial Q4 FY26 earnings call. On behalf of ICICI Securities, I would like to thank Mass Financial management team for giving us the opportunity to host this call. Today we have with us the entire top management team of Mass Financial, represented by Mr. Kamlesh Gandhi, Chairman and Managing Director, Mrs. Darshana Pandya, Executive Director and CEO, Mr. Dwanil Gandhi, Executive Director, Mr. Ankit Jain, CFO, and other senior management team members. I will now hand over the call to Kamlesh Bhai for his opening remarks, and then we'll open the floor for Q&A. Over to you, sir.
Thank you, Renish, and good afternoon to all of you. I'm very happy to connect with all of you for expressing this Q4 result of the company and for the whole year for 25-26. So I'll be sharing the result with you. So I will start with a few very important milestones that we have crossed this year. So we crossed around 15,000 crores in AUM. Very importantly, on a consolidated basis, we also crossed 500 crores in PBT, that is profit before tax, and also 100 crores in profitability for the quarter on a consolidated basis. So this was the important milestone which we achieved this quarter. In terms of growth, if you see the growth on a consolidated basis is around close to 19%, increase in profitability by 21% on a year-on-year basis for the whole year. And if you take for the quarter performance on a corresponding quarter, it is the rise in profitability is by 25%. So on standalone basis also, it reflects in the same way that it is 19% growth in AUM, 20% growth in profitability for the whole year. And for on a quarter-to-quarter basis, it is something like 23% increase in profitability, while maintaining very strong quality of assets too. If you see the quality of assets in both our companies, we have seen that in our parent we have maintained the NNPA at a level which was earlier maintained at around 1.70% despite of tremendous headwinds during the year. And in our housing finance company, we continue to maintain an excellent quality of assets at at around 0.67% of net NPAs, while we carry additional buffers in both the companies. Now, to take you briefly on what we did on the asset side, liability, operations, stack, and take you through very briefly. On the asset side, we continue to focus on MSME, that contributes more than 70% of our business, and that includes MEL and SME business, that is micro enterprise loans given to individuals and the small and medium enterprise loans given to the bigger entities, and that constitutes around 70% of our business, and our focus will continue to remain on the same as we have been doing the same since last 30 years. While the increase in the wheels business over a period of time will slightly add to the diversification of the assets going forward. On the distribution side, we continue to have a very strong distribution across our more than 200 branches and 16,000 centers reach, and we'll continue to expand this year also. So we'll continue to consolidate our distribution in both the channels, that is our direct channels through increasing of branches and increasing our centers reach, and also through our partnership with NBFCs, which is now close to a 15 years old proven model. So on the asset side, we continue to have the confidence to grow anywhere between 20 to 25%. given the positive macro situation, because we always prioritize risk management and profitability over just the growth, and that all of you are aware since looking at our performance over all these 3 years. On the liability side, we remain very strongly capitalized. We have around close to 23% of capital adequacy, with a very strong capital Tier 1 of around 21.5%, and that gives us a very strong balance sheet, and we'll continue to maintain the capital adequacy of around 20% going forward. So that will keep the balance sheet very strong. On terms of debt raising, while Ankit will take you through in detail, we remain very confident, and we have, because of our immaculate track record for all the times. And currently, as I talk to you, we have a debt tap almost for half the year for 26-27, and we see no reason why we will not be in a position to tap very soon for the whole year. But the challenge will be mainly how to have a better rate of interest, and that we already started gaining the momentum on that from Q4 onwards. So that is where we are going to focus on decreasing the rate of interest and improving on the diversification of liabilities also. On the ops front, we continue to focus on tech. As I've shared, that we have a tech which we have built and we operate on built and operate module. We have close to 100 people working in tech, and we are gaining good traction in various products. So the LOS has been successfully launched for all the products, and now we are in the process of launching BRE with the help of AI. And with the sufficient data at our disposal, I think we'll be in a position to use that very effectively, and that will help to be more efficient in terms of providing the customer services, and also in terms of improving the efficiencies of our employees, and the tech will be complementary to them, and at the same time can, in the medium to long term, help in reduction in cost. On HR front, we continue to pursue the dictum of failing and succeeding together, and that has kept us in good state. Minimum or practically no attrition at the middle and the top level. And while we are now 4,800 strong team with close to 500 of them with us for more than 5 years, the focus is now how to increase the efficiencies and how to take this organization to the next level, along with taking the current employees also to the next level. On the housing front, that company grew at around 23%. We would aspire to grow this anywhere between 30 to 35% given its lower base. So we are at a striking distance away from 1,000 crore. Ideally, we would have liked to touch 1,000 crores by this year, but it may take a quarter more now. But the silver lining is the very strong profitability. If you see the profitability for housing finance on a quarter-on-quarter basis on a corresponding quarter basis has been 40%, on the whole year has been 36%, with a very strong quality of assets at around 0.68% of net NPA. So without compromising on all such parameters, we'll continue to see to that how we can take it to the next level of growth. So before I hand over to Darshan, let me share with you, and I'm happy to share that we'll be declaring a final dividend of 75 paisa per share, taking it to a total dividend of 2 rupees per share, that is 20% on the face value. We continue to maintain the strategy of a 10% dividend payout. So the total dividend payout for the whole year will be on a profit of around close to 366 crores, will be around 36 crores. And out of that, 1.25 rupees per share has already been declared and paid after December, and a final dividend subject to the shareholders' approval at the rate of 75 paisa per share will be done in due course of time. So this is on declaration of dividend. So going forward, once again, let me reiterate that as demonstrated over all these 3 decades, we continue to follow the strategy of a prudent growth, a profitable growth, and that too anywhere between 20 to 25%. And we are very hopeful, as I shared with all of you on the Investor Day conference on 16 February, that we are pursuing our vision of 2036 to be a 1 lakh crore AUM. So the way we are going ahead it is really ambitious, but we don't think that we far-fetched for Team Mars. So with support of all of you and with all of us being on the mission mode, we are very confident of achieving that in the medium to long term. So with this, I'd like to hand over this to Darshna. She'll take you through the details of the numbers and then to Ankit, and then it will be open for question and answer.
Thank you, sir. Good afternoon, everyone. So, once again, I'm very happy to connect to all of you, and I'll take you through the key numbers, first on consolidated basis and then on standalone basis for both the companies. So if we look at the AUM, AUM stands at 15,304 crores as compared to 12,868 crore in last year, which is around 19% growth in AUM. And if you look at the quarterly PAT for the last quarter, it is 104 crore as compared to 83 crore, which is 25% growth in PAT. And if you look at the annual PAT for the whole year, it is on consolidated basis, it is 379 crore as compared to 314 crore, which is 21% growth in PAT. Now coming to the standalone number, if we look at the asset configuration, so AUM grew by 18.71%. So there is a growth of around 20% in our micro enterprise loan from 4,793 crore to 5,737 crore. Growth of 15.78% in SME book from 4,500 crore to 5,213 crore. Two-wheeler book grew by 35.43% from 785 crore to 1,063 crore. Commercial vehicle, there is a growth of 11% from 979 crore to 1,085 crore. And salaried personal loan, there is a growth of around 21% from 1,039 crore to 1,264 crore. Our total income, if we compare the quarter, total income grew by 23.86% from 417 crore to 516 crore. Profit before tax grew by 22.28% from 109 crore to 133 crore. Profit after tax, there is a growth of 23.39% from 81 crore to around 100 crore. On annual basis, our total income grew by 25% around from 1,520 crore to 1,900 crore. PBT grew by 20% from 410 crore to 493 crore, and PAT grew by 20% from 306 crore to 367 crore. About the quality of the portfolio, as shared that it remains stable and strong. 2.5% is gross stage 3 asset as compared to 2.56% in December 25. And net stage 3 asset is 1.70% as compared to 1.72% in December 25. Regarding the numbers of our housing finance company, there is a growth in AUM of 22.41% from 768 crore to 940 crore. PBT grew by around 46.53% on quarterly basis from 3 crore to 26 lakhs to 4 crore 78 lakhs. And PAT, there is a growth of around 40% from 2 crore 64 lakhs to 3 crore 70 lakhs. On yearly basis, total PAT PBT grew by 39% from 12 crore to 16.85 crore, and PAT grew by 34.88% from 9 crore 56 lakhs to 12 crore 90 lakhs. Here also we could maintain the quality of the portfolio, so gross stage 3 asset is 0.98% as compared to 0.97% in December 25, and net stage 3 asset is 0.68% as compared to 0.67% in December 25. So this was about the key numbers. Now I'll request Ankit to take it forward.
Thank you, ma'am. Welcome to all. On capital and liability management, the company through its effective liability management has maintained an average cash and cash equivalent balance of approximately rupees 1,000 crore, and along with it unutilized cash flow facility of more than 200 crore. As on 31st March, the company also holds sanction facility of more than 2,000 crore, comprising of term loan, NCD, direct assignment, co-lending, etc. During the last quarter, the company executed direct assignment transaction amounting to 940 crore and further have sanctions of more than 500 crore in the form of direct assignment co-lending, which we plan to utilize over the current quarter. Our strategic goal remains same, to maintain 20 to 25% of asset under management as off book. We have cash facility of approximately 1,550 crore spread over 14 banks, of which we maintain utilization level of around 70-75%, keeping the remaining portion as liquidity buffer. In terms of long-term borrowing, the company raised rupees 750 crore through term loan with an average maturity of 3 to 5 years. We also have sanctioned term loan pipeline of approximately rupees 1,300 crore. Additionally, rupees 100 crore were raised through NCDs during the quarter. We are strongly positioned in terms of structural liquidity. Our liquidity position remains adequate with positive cash flows across all cumulative time buckets. Our capital equity ratio remains strong at 22.84%, with Tier 1 capital at 21.50% and a debt equity ratio of 3.31x. The average cost of borrowing for the quarter stood at 9.39%, a 42 basis point reduction from the last year same quarter. Would like to highlight that this cost of borrowing is calculated on daily average balance and also include all costs incurred against borrowing and not just ROI. We, in medium term, plans to further diversify our resource mix by fresh fundraise through ECBs, FD, foreign and development finance institutions, mutual fund, PMS, etc. at competitive cost. Thank you. Now we are open for Q&A.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and then 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to all, you may press star and then 1 on your touchtone telephone to ask a question. We will take the first question from the line of Abhijan from AJ Capital. Please go ahead.
Hi, good afternoon. Hope I'm audible.
Yes, you're audible, sir.
Yeah, hi. Hi, Mr. Gandhi. Hi, Ms. Darshana. First of all, I would like to congratulate you on the credit quality improvement that I'm seeing across the market, right? Your 0 DPD, your 1 to 30, 31 to 60. If you just leave aside 91 to 120 DPD, you have done a phenomenal job over the last quarter. So clearly what you were narrating last year, in the last quarter, right, that in the next 2 quarters you will see all your credit quality issues and, the NPA subsiding in the microfinance book. That seems to be taking place. So congratulations on that. I'm also happy that this year round in this quarter, your provisioning coverage has gone up. I can see it is at 41.89%. Hopefully sometime in the future, you can be a leader in this category as well, and you can take it up to 50, 55, 60%, like many other NBFCs do. That is my hope, and hopefully you are on track on that. So my first question was generally, in today's scenario of big data and AI, right? So a lot of information, a lot of data sets are available to all the lenders, to all the financial institutions. I want to get some flavor and understanding from you as to how you are leveraging it for your risk-adjusted growth. Because if you see around you, right, the data is so easily accessible. Forget about the institution, right? Even to retailers, even to smaller customers and everyone. So I just want to understand the data edge of Mars. Because I'm happy with your ambition of, going up to 1 lakh crore AUM in the next 10 years, but on a, CAGR basis at 20% growth. If you look at some of the biggest peers, like just Bajaj had a Concall yesterday, their ambition is to grow at 22 to 24% CAGR, even at a 5 lakh crore book. So just can you help us understand as investors, how is data helping you or how are you leveraging data? Because that I think is a necessary ingredient for a financial growth in this country.
Right. So as far as data is concerned, what I would like to share with you is that the usage of data for every company is unique to them. And the experience of that data, it's very important that what experience we had from that particular data and how we use it in risk management. If I just give you an example that if you just take a generic approach that I have this much of data and then extrapolate it on various parameters, that is what happened to fintech in their earlier days when their losses were anywhere between 10 to 15%. So when we talk about using our data, it is more on our experience on the data that we already have with us. We would not just presume basis just the credit score is good, so that means that the quality of the asset or the risk management has to be seen that way. So what we do is that with the available data with us, backtesting our risk models on those data, we take the decisions, and that is how technology will help us in our risk assessment. And by using this technology, what helps us is that we get very consistency in assessment. So once we have put certain scoring models at place, there will be a lot of consistency in the way we assess the borrower. So that will not only reduce stat, but that will bring about consistency in assessment also. So the use of data will progressively increase as we have more and more data points which have been used and which have demonstrated certain characteristics for us. No, I am not going to draw data only from all the sources and then judge the risk model or prepare the risk model. So the risk models are prepared basis the data experience we have from time to time. So as and when we have more and more data, this will progressively get improved. Just for example, we just started with LOS, then we have now business rule engines. Now these business rule engines, once they are around 6 or 9 months old now, we are shifting to AI-based risk management. So gradually we will be using technology the way we have the data at our disposal and the characteristics of the data that we examine from time to time.
Yeah, that helps. Secondly, sir, just staying on data and understanding data, I wanted to understand that do you also have an early warning system in place, which helps you with your risk management? And can you throw some flavor around that? I mean, is it more ad hoc? Has it helped you in the past in this MFI cycle that you were seeing? Did your early warning signal help you to curtail your book, curtail your lending practices, and that helps you manage risk? Because obviously now we are at the end of the cycle, but I just want to understand from a future readiness perspective, how is Mars differentiated from other financiers in terms of risk management? Your track record speaks for itself. I mean, there is no doubt about it. And we can see the credit quality. But just give us some flavor around what these early warning signals might be within the company, if you can.
See, the most potent early warning system is your ears very close to the ground. Because when the early warning signal starts appearing on the data, that means the things have already started going bad for us. So the biggest thing what we do is that have our ears very close to the ground, assess the ground level situation, talk to various borrowers. I just give an example that soon after the Middle East crisis kicked in, we talked to as many as more than 2,000 to 3,000 borrowers in our commercial vehicle segment, took the feedback from them that how they are affected and what they think they will be affected in the future, and taking the feedback from our feet on street, not just sitting in the conference room and understanding basis our wisdom. So the first thing is that having ears very close to the ground. Secondly, obviously, from the data that what are the non-starter cases, which are the early delinquent cases, and what are the characteristics of all those type of cases. And since we have 100% banking based or ENSEH based collection, the bouncing is also an early warning signal. So based on the bouncing and the data that we collect from the ground, we frame our credit screens from time to time, and the risk management is done accordingly.
Yeah, fair, sir. Thank you. And I know that 1 lakh crore AUM is a target risk adjusted growth, but I hope that the company ends up achieving a bit more ambitious target, a bit more ambitious growth. So, congrats and best of luck for that.
Thank you.
Thank you. We will take the next question from the line of Devin Modi from Erdeco. Please go ahead.
Yeah, thank you, sir, for the opportunity, and congratulations on a consistent set of numbers. Firstly, wanted to check that the greater than 1 DPD trend seems to be showing early signs of improvement and very sharp improvement in the 1 to 90 DPD bracket, probably the best absolute level since March 24. So could you share any flavor on this and what on-ground signs we are seeing that could play out ahead, going ahead? Also, the West Asia crisis and the general inflationary trend that would be there because of higher crude and other input prices, would it affect the incremental lending environment? And would there be a possibility of some reversal of this trend of higher NPAs? Also, how do we price this risk in an appropriate manner?
So, as you rightly told that the quality of the asset has been very steadily improving. And all the steps that you take post any of the stress, or so-called stress, it was not a stress as far as we were concerned, but the market was in stress, it takes time to show results. So that results are now showing off that since 24, what one steps were taken in order to extend credit where it is due or to tighten the credit screens, that was evident in the numbers this quarter. And secondly, these are all dynamic situation. I hope that this crisis does not spiral out of control, and the borrowers whom we are funding will be in a position, will be in a good financial position as they are right now. So that is what we presume. But if something goes out of their control, that can slightly reflect once again on the asset quality, because there is something that is beyond our control once we have already disbursed it. But what keeps us in good stead on asset quality is being agile, as I answered to the earlier query, is that we have our ears very close to the ground, and we say to that we act proactively rather than reacting to a situation. So as of now, as I talk to you, we think that this asset quality should be maintained, but keeping a close watch on the current situation, where we all know that there is a potential inflationary trend setting in, and we need to see that how exactly that spans out for our borrowers. But we are quite agile. If you just give an example, that we are quite agile in how we lend to the borrowers who are energy dependent, who are into logistics. So there, if you can see that our CV portfolio, we are cautiously being growing at a lesser pace. So these are all the precautions that we have taken, and we would like to say to that this quality trend which has set in, that continues.
Okay, sure. But on ground, basically because of whatever developments, you are not slowing down your growth rates as of now, as yet, in terms of the asset advances growth rates?
No, not now.
And just one more question. What will be the further room of improvement on the current quarterly cost of borrowing of 9.39% annualized, which we have shown in this quarter? Is there further room of improvement there, and in how many quarters one can expect that to play out?
I think from 9.39, we can see this going down to around, say, 9.20 to 9.25 over next 2-3 quarters.
Okay, this is the incremental quarterly cost of borrowing.
Yeah.
And if we can squeeze in one more question. Basically, we have this cost of basically the origination of around 36 crores, which has gone up unduly on a year-on-year basis. However, it does seem that it is a cost related to the other income that we have. So how do we see that? And this is one of those quarters wherein the other income is relatively lower at around 20 crores, while this cost is around 36 crores. So any explanation of him and how that is skewing our operating expenses per se?
There are two parts to it. On the fees and income, fees and commission on the income side, it depends upon the disbursement in a particular product, that how we are doing a disbursement in a particular product, that whether the portion of the interest is charged upfront as fees or commission, or it has been built up in the interest yields. If you see for this quarter, our yields have increased by almost 0.5%. So that is more of the marketing strategies that a company uses, that whether we are going to build up in the interest rates or we are going to charge as fees and commission. That was on the income side. On the expenditure side, while it will correspondingly grow along with the growth in the asset side, the other component in that is that we have been sourcing business through fintech, whereby for a better control on the transaction, we will be booking the complete interest in the book. At the same time, whatever the interest difference has to be paid, as that is being booked as commission to them. So around close to 10% of our business, 10 to 12% of our business is from fintech. So depending upon that business, the fees and commission is structured from time to time. So these are the components. But as far as the OpEx is concerned, what I would like to draw the attention is that since we are a multi-product, multi-distribution company, the right way of looking at it is that whether we are in a position to maintain our ROAs or not. So the complete hierarchy works like this, that we charge a yield, and then we have to bear the cost of interest, then we get our NIMs, and from that OpEx and the credit cost is being appropriated. So in case where the fees and commission as an expenditure increases, our income also increases at the top, and that is where allows us to maintain the ROAs anywhere between 2.75 to 3%.
Perfect. That's it from my side. Thank you, sir.
Thank you. Before we take the next question, ladies and gentlemen, in order to ensure that the management should be able to address all the questions from the participants in the question queue, we request you to kindly limit your questions to 2 per participant. If you have a follow-up question, please rejoin the queue again. We will take the next question from the line of Ishan Gupta from Choice Institutional Equities. Please go ahead.
Yeah. Good afternoon, sir. So my first question was, despite our direct sourcing still remaining at 64%, our sequential growth in the segments like SME has increased. Despite that, our average yields sequentially has moved higher by around 40 bits. So what is the reason attributable to that?
Can you come again? I could not really understand your question. What are you trying to ask?
My question was, our average yields on loans have increased around 40 bits sequentially, despite our direct business staying at around 64%, and the least yielding product, that is SME, grew fastest sequentially. So what was the reason for increase in yields sequentially?
So that was one of the reasons, as I told, that the yield also reflects our partnership with fintechs plus the growth in the two-wheeler business. Two-wheeler business, the yields are anywhere between 19 to 23%. So if you see, the two-wheeler business grew by 35% this year. So this two combination helped us to increase the yield by 0.4%.
Okay. My second question is regarding the higher credit cost observed during the quarter. So was it due to the impact of West Asia conflict or some stress in certain pool accounts?
No, nothing like that. We, as a forward-looking reason, we have this year little aggressively written off the 90 DPD assets. So ideally, we would lose like 2.57%. We have written off more than 0.10% of the assets aggressively rather than showing higher profitability. So we, in a sense, this is a sort of a buffer write-off that we have done. While we are expecting recovery, but we have aggressively written off because we had that profit on the books to do that. So we have utilized that profit rather than showing more profitability. We opted for more write-offs.
Got it. And then last one, if I can squeeze in. In the Gujarat state, we have observed that there's a decline in number of branches by 2. So what could be the reason? Because Gujarat remains our core focus area. And how do we plan to grow our branch network in the upcoming 2 years?
So this recalibration of branches across states is a very dynamic process. This happens because we don't open branches just for the count of it. We need to see that how the branches are contributing and what is the potentiality. So in order to see to that the OPEX does not go absolutely out of hand, such decisions are taken from time to time where certain branches are merged or certain new branches are opened. So that reduction of 2, what you see is because of that fact, and that's a very continuous process. But if you see overall, this year we did not increase much branches because we were in the process of sweating our existing branches. So we believe in building up squares rather than just doing a linear expansion. We want our branches to sweat and to contribute to the profitability. And having done that in the last year, this year we should see the increase in branches from anywhere from 30 to 35 branches this year across our area of operations.
That's it from my side.
Thank you. We will take the next question from the line of Meghna Luthra from InCred Equities. Please go ahead.
Yeah, hi sir. Thank you for giving me an opportunity to ask questions. So like you mentioned that two-wheeler book and the peer book was one of the 2 main reasons for the boost in yield. So but last quarter, two-wheeler book grew at a higher pace on a sequential basis than this quarter. So on a sequential basis, sir, what would be the reason for yield and movement?
So yields, we being a multi-product company and depending upon the opportunity and the products offered to the markets from time to time, even within what I alluded to was that this might be the 2 major reasons. But even within SME, we operate various segments, right from say tying up with likes of PhonePe to giving a loans right up to 5 crores. So depending upon the configuration of the business within the SME segment also, within the MEL segment also can also have the impact. But the major impact can be because of the increase in our fintech business and the two-wheeler business and accompanied by the yield increase in our SME business, maybe because of the different type of products that we operate in. So that might have resulted into a slighter higher yield. And in the last quarter, it might have been offset by certain type of products which are low yield, taking the precedence over the products which have a lower yield. So this calibration of various products happens over a period of time, and hence the yields are range bound. So that is what we call it, that we keep a range bound yield anywhere between 16 to 17%.
Got it. So we could see this level of yield at a sustainable level for FY27 as well, right?
That is on the quarter. 16 to 17%.
Got it. Okay, thank you, sir. And another question would be on how do we see credit cost to pan out for FY27 and 28, and the same thing for cost to asset or cost to income ratio.
The credit cost, I think we always maintain that it will be anywhere between 1 to 1.25%. a few basis here or there, because if we have the room, we believe in writing off aggressively within our NPA assets. This is how one way we create buffers on the balance sheet. But ideally, on a statistical basis, it can be anywhere between 1 to 1.25% on our closing AUM. And on cost to income ratio, I think currently we are at around 35, a range bound between 35 to 37%. I will once again reiterate that should not be seen in isolation. It should be seen on the overall metrics, that if the yields are higher, that OpEx can also be higher, because those products are sold which are having higher OpEx and higher yields. So at the end of the day, we would like to maintain that the ROAs after OpEx credit cost appropriated from our NIMs, it will be anywhere between 2.75 to 3%.
Got it. That's very helpful. Thank you.
Thank you. We will take the next question from the line of Shripal Doshi from Equirus. Please go ahead.
Hi, sir. Thank you for giving me the opportunity and congrats on a good quarter. So my first question was on the update on LOS and BRE. So while we had rolled out that in the last quarter itself for all the products, just wanted to understand how are the trends with respect to rejection rates? Any other update are we able to sort of gauge in terms of any industry facing issues? Because we had highlighted earlier also that textile, FMCG were a couple of along with agro-linked MSMEs were a few industries which had got impacted. So anything that our BRE and tech initiatives also helping us in terms of picking up some more let's say ground level updates, and just update on the implementation of LOS and BRE.
Hi. So LOS implementation, as you mentioned, has been done across the product. Now it is all about enhancements and adding the BRE from the BRE across to all the products. So we have as mentioned in the opening remarks as well, that two-wheeler is one product where we have made good progress in terms of faster processing, faster disbursals, automated rule engines. So good progress has been made there. On the MSME side, overall, I think those are those sectors that you mentioned, textile, agro, stay cautious for us still for this quarter as well. And additionally, in the last month, in February end and March, mid of March, we added petrol pumps, gas agencies, transporter profiles, certain chemical related industries also into caution profile. So as a cautionary mechanism, we added those because we wanted to see that what effect does this Middle East supply of gas and all of those things have an impact on these sectors. So we are a little bit cautious on that. Other than that, it is things as normal. The approval rates have been decently maintaining a very steady percentage, wherein we are happy with those numbers, and we would want to see those numbers getting continued in the new financial year as well. So post the Diwali and the GST cut, what exuberance that we were seeing, I think Q4 is also seasonally stronger. So we saw that good momentum of business. Hopefully after these election results and all, there are no very massive negative surprises on inflation and all. If that doesn't happen, then we see the good momentum going into new financial year as well. So no new additions per se on the except for the ones I mentioned on the caution or the negative list as of now.
Got it. Just a bit on the approval rate. So is post the implementation of this BRE, are we seeing what is the kind of change that we have seen in terms of what the approval rates were earlier versus now for, let's say, some of our key products such as MEL and MSME?
So what happens is that earlier we had policy parameters which would get which would get verified by our credit managers manually. Now that manual intervention of checking the credit parameters has been given to the system, where the system will run those algorithms and then give a score, and based on that score, risk pricing and approval or rejection will happen. So currently, the first step is automizing the process, and second step is that how can the process automation also lead into us getting more insight that how exactly the rules should be framed. So currently, we have not tinkered a lot in terms of rules framing. We have kept the rules more or less the way we used to do them earlier. We still want to run this scorecard for another 1 or 2 quarters and then see the output coming out on the scores, and then maybe run some statistical models on those and then come out with maybe newer policy parameters. So this is a continuous exercise that we keep on doing, and we have successfully achieved the first step, and we are working towards the next steps as well. So MEL is still a little bit difficult to convert to absolutely score based because of the physical assessment and requirement of physical visit and all. But at least in SME, where formal data is more reliably available, we are able to do this more effectively. So MEL, I would say, is still more of manual in terms of underwriting and rules and all. But we are exploring ways to automate that as well, because we feel that optimization of credit resources, sales resources is required to get OPEX under control. So we are exploring MEL, maybe kaise we can do more of automation through BRE, but SME is a very ripe product to do it.
Got it. Thank you so much for that detailed answer. Just a second question was on the credit cost front. So I suppose post the ECL review, the credit cost requirement has gone up. Incrementally, we should see the credit cost at closer to 1.5, 1.6%. Is that a fair assumption to move ahead with?
See, on close, how you take the denominator on the closing AUM, we should see that at around anywhere between 1.25 to 1.3 or something like that. But as I shared earlier, that if we opt for some aggressive write-offs during the quarter, profit permitting, so that should see us anywhere between 1.5% as you told, but without disturbing much on our ultimate ROAs and ROEs.
Got it, sir. Thank you so much, sir, for answering my question. Good luck for the next quarter.
Thank you.
Thank you. Before we take the next question, a reminder to all the participants, you may press star and then 1 to ask a question. We have the next question from the line of Aditya from Securities Investment Management. Please go ahead.
Hi, sir. Thanks for the opportunity. So I just wanted to understand what is the write-off policy which we have for our different loan segments, and in this quarter, the loans which we have written off, are these more pertaining to unsecured or secured loans?
The write-off policy is that we write off post 360 days, and this year what we have written off, it's not off the cuff data I have, but it might be a combination of secured and unsecured. More in unsecured.
Understood. And this post 365 days, it is applicable for all product segments, or it is different for different products?
No, it is applicable on all products.
Understood. And sir, on recovery, so do you expect these loans to get recovered, and how do you account for recovery? So is it accounted in the credit cost itself, or it's part of other income?
Great question.
So what all amount is recovered from this account are written back. So the figure which is in the P&L will be the net figure.
Understood. Next was on net interest income growth. So if I look at sequentially, your NII growth is around 11% as against our AUM growth of 4%. So you mentioned some of the reasons were because of improved product mix and lowering of borrowing costs. But how big the assignment book plays a role in this? Because when I look at the quantum of assignment incurred this quarter, it is almost doubled from last year. So just wanted to get a sense how big a role does assignment play in your higher NII growth? Because I believe there is some upfronting of income because of assignment.
So I don't know whether you recollect, we were the ones who always advocated that we would not like to upfront but amortize the income. So the other way around, in order to calibrate that, we do sufficient provisioning that it is very close to an amortized income only. So we do not upfront income in order to improve the profitability or the NII growth. So that is very, very close to an amortization levels only. And the reason for the NII rise this quarter was because of the interest cost. If you see the interest expense for Q3 and Q4 were same, almost same. If you see the interest expense for Q3 was close to 81 crores. That remained right.
290.
Huh?
290.
So in short, it remained same for both the quarter, 219 and 221. And that was because the incremental cost of borrowing is now 9.39%, what it used to be around 9.75 to 9.8%. So this resulted in higher NII. And secondly, this happened in this quarter because there was a lot of MCLR reset this quarter. Because we have an MCLR reset every year. So there was an MCLR reset this quarter and hence this impact.
Understood, sir. Thanks for that clarification. And also going forward now, NII, so you are expected to get further benefit of 15-20 basis on your borrowing side. So are we passing on this incremental rate benefits to our customers or we are keeping the yields stable?
It all depends upon the market situation. As of now, the way we are operating at a competitive rate. So if this rate reduces, more it will be a combination of both, that we'll be keeping it something for ourselves and something might be passed on to the borrowers. But difficult to predict right now. It all depends upon the market situation going ahead.
Understood. And so last question was on a CV book. So we have been a little slow in growing our CV book, and I think for the last many quarters now. As against when I look at the industry growth, the CV industry is doing pretty well. So just wanted to get a better sense from you. What are you seeing in your segment which is restricting you to grow a CV book?
That is all about the perception of the quality of the assets that will happen over the next few quarters, depending upon the current situation. So we see that whenever there are any sort of abnormal situation which we are going through right now, the first casualty is the logistics and the transport. So looking at that, we internally from the risk perspective, we understand that this book should grow at a slower pace for coming 1 or 2 quarters before we really pick up the pace in parallel to the overall growth of the AUM of the company. So our perception right now is that we would like to wait and watch, and we would like to grow slower for coming 1 or 2 quarters.
Aditya, does that answer your question? Do you have any further questions?
No.
Thank you very much. Ladies and gentlemen, we will take that as the last question for today. And with that concludes the question and answer session. I now hand the conference back to the management for closing comments.
So thank you everyone for sparing your valuable time and attending this analyst call. And as I shared in the beginning, that we remain confident of growing steadily anywhere between 20 to 25% towards our mission which we have set for ourselves for 10 years of reaching 1 lakh crore a year without compromising on the quality of the assets and profitability. And that we have demonstrated over last 3 decades. So thank you for joining and look forward to being in touch. Thank you.
Thank you, members of the management. On behalf of ICICI Securities, that concludes this conference. Thank you all for joining with us today, and you may now disconnect your lines. Thank you.
Thank you.